In January 2019, WeWork was worth $47 billion. It was the most valuable startup in America, bigger than Boeing, bigger than Ford, bigger than Goldman Sachs. Investors were lining up. The media called its founder a visionary. SoftBank had poured billions into it. An IPO was coming that would make everyone rich. By November 2019, 10 months later, WeWork was worth less than $8 billion. Its IPO had collapsed. Its CEO had been forced out, and the company was days away from running out of cash entirely. By 2023, WeWork filed for bankruptcy. $47 billion gone. This is not just a story about a bad company. This is a masterclass in how financial illusion is built, sustained, and ultimately destroyed. And every single lesson in this story applies directly to how you evaluate money, your own and other people's. Before we get to the collapse, you need to understand what WeWork actually was, because most people never did. WeWork was not a tech company. WeWork was a real estate company. Here's the business model. WeWork signed long-term leases on commercial office buildings, typically 10 to 15 years. Then it renovated those spaces into trendy, flexible offices and rented them out short-term to startups, freelancers, and eventually large corporations. The pitch was simple. We take boring office space and turn it into a community. We're not just renting you a desk, we're selling you belonging. Adam Neumann, the founder, was extraordinary at selling this vision. He talked about WeWork's mission to elevate the world's consciousness. He called it a technology company. He compared it to Apple, Amazon, and Alibaba. Investors believed him, but underneath the kombucha taps and the inspirational murals was a business with a fundamental structural problem. WeWork owed billions in long-term lease obligations. Its revenue came from short-term memberships that customers could cancel anytime. It was borrowing long and lending short. In real estate terms, that is one of the most dangerous financial structures that exists. The story of WeWork's rise is inseparable from one man, Masayoshi Son, the founder of SoftBank. In 2017, Son met Neumann for 12 minutes, just 12 minutes, and then he wrote a check for $4.4 billion. Son later said he preferred crazy founders because only crazy people change the world. Over the following 2 years, SoftBank's Vision Fund poured approximately $10.65 billion into WeWork, making it by far the largest investor and the primary reason WeWork's valuation kept climbing. Here's the mechanism that most people don't understand. When a major investor like SoftBank puts money into a private company at a specific valuation, that valuation becomes real, not because it reflects the actual worth of the business, but because a credible investor has agreed to pay that price. WeWork wasn't worth $47 billion because it had $47 billion in assets or earnings. It was worth $47 billion because SoftBank said it was. And as long as no one tested that number against reality, it held. The IPO was about to test it. In August 2019, WeWork filed its S-1, the document required to go public on the stock market. For the first time, the world could see WeWork's actual financial numbers. And what they saw was stunning. In 2018, WeWork had revenue of $1.8 billion. It also had losses of $1.9 billion. It was spending $1.06 for every $1 it made. The faster it grew, the more money it lost. The S-1 also revealed that WeWork owed $47 billion in future lease obligations, meaning even if every single customer canceled tomorrow, WeWork still owed $47 billion to landlords. And then the governance details emerged. Adam Neumann had personally trademarked the word "we" and then sold the trademark back to WeWork for $5.9 million. He had taken out $700 million in loans secured by his WeWork stock and used some of that money to buy real estate that he then leased back to WeWork. He had a private jet paid for by the company. He had smoked marijuana on a flight to Israel. He had a $60 million compound in Westchester, and his shares carried 20 votes each compared to 1 vote for regular shareholders, giving him virtually unchecked control of the company. Within days of the S-1 filing, the planned IPO valuation dropped from $47 billion to $20 billion, then to $15 billion, then to $10 billion. The IPO was pulled entirely. In September 2019, under pressure from SoftBank and the board, Adam Neumann resigned as CEO. His exit package was extraordinary. SoftBank paid Neumann approximately $1.7 billion to leave. This included $185 million as a consulting fee, nearly $500 million to buy back some of his shares, and a $432 million loan forgiveness. The man who had driven the company to the edge of bankruptcy walked away with $1.7 billion. The employees who had been promised stock options worth millions watched those options become essentially worthless. 3,000 people were laid off in the months that followed. This is one of the most important financial lessons in the entire WeWork story. The people closest to the money, the founders, the early investors, the executives, had structured their compensation to extract value regardless of whether the company succeeded. The people furthest from the money, the employees, the late-stage investors, the public market buyers, absorbed the losses. Understanding who gets paid first when things go wrong is one of the most critical concepts in financial literacy. With Neumann gone and the IPO collapsed, WeWork was days from insolvency. SoftBank agreed to a rescue package, injecting approximately $9.5 billion to keep the company alive. In exchange, SoftBank took majority control of WeWork. The irony was painful. SoftBank had poured billions into WeWork to make it worth $47 billion. Now it was pouring more billions in just to prevent it from going to zero. WeWork tried to restructure. It sold off businesses, it laid off thousands, it closed unprofitable locations. Then COVID hit in 2020, and the demand for shared office space collapsed overnight. WeWork's core business model, people working together in open offices, was exactly what the world was trying to avoid. The company struggled forward for 3 more years. In November 2023, WeWork filed for bankruptcy. Total estimated losses to investors, over $40 billion. SoftBank alone lost approximately $14 billion on WeWork, one of the largest single investment losses in history. So what does the WeWork collapse actually teach us about money? Lesson 1. Revenue is not profit. WeWork had $1.8 billion in revenue and was celebrated as a success, but it was losing more than it made. Revenue without profit is not a business, it's a countdown. Lesson 2. Valuation is not value. WeWork was worth $47 billion because one investor agreed to pay that price. That number was never tested by the market. When it finally was, it evaporated. Always ask, what would this be worth if the biggest believer walked away? Lesson 3. Long-term liabilities plus short-term revenue equals fragility. WeWork owed money for 10 to 15 years. Its customers could leave in a month. That mismatch was a structural bomb. Always match the duration of your obligations to the duration of your income. Lesson 4. Who gets paid when things go wrong matters more than who benefits when things go right. Neumann walked with $1.7 billion. Employees lost everything. Before you invest in anything, a company, a fund, a deal, understand the payout order when it fails. Lesson 5. A great story is not a great business. Neumann was one of the most compelling storytellers in Silicon Valley history. He raised $12 billion on the strength of that story. But underneath the story, the numbers were broken from day one. Always look at the numbers, not just the narrative. Here's the ending that will either inspire you or infuriate you, depending on how you look at it. Adam Neumann walked away from WeWork with $1.7 billion. In 2022, he started a new company, a residential real estate startup called Flow, focused on turning apartment buildings into communities. Andreessen Horowitz, one of the most respected venture capital firms in Silicon Valley, invested $350 million in Flow, at a valuation of over $1 billion, before the company had launched a single product. The pitch? Neumann's vision for transforming how people live together. Sound familiar? The financial world did not learn its lesson. Or rather, the financial world decided that Neumann's ability to raise money and generate excitement was itself worth $350 million. Whether Flow succeeds or fails is an open question, but the fact that it exists and that it raised $350 million on Neumann's name alone tells you everything about how money and storytelling interact at the highest level. Here's what I want you to take from this story. WeWork was not a mystery. The problems were visible to anyone who looked carefully at the numbers. The losses were in the filing. The lease obligations were in the filing. The governance issues were in the filing. Most people didn't look. They looked at the offices. They looked at the valuation. They looked at the confidence of the man selling the vision. Numbers tell the truth. Stories tell what someone wants you to believe. Your job, as someone who manages money, invests money, or evaluates financial decisions, is to find the numbers underneath the story, every time. So here's the question. Have you ever made a financial decision based on a story rather than the numbers? Write it in the comments. I read every single one. And if this changed how you see financial news, share it with someone who needs to see through the hype. I'm Finn, and this is what money is really about. Next week, Enron, the most sophisticated financial fraud in American history, and the 5 warning signs that were hiding in plain sight for years. Subscribe so you don't miss it.